Welcome to the Region's Economic and Markets Roundtable discussion. I'm Jeremy King, joined today by Chris Scribner, Public Policy Manager of Government Affairs for Regions, as well as Regions Chief Economist Richard Moody and Chief Investment Officer Alan McKnight. In this podcast, we'll address some of the latest issues affecting investments, including the political climate, and we hope you'll come away with insights that can help you make informed financial decisions moving forward. Before we get into the heart of the discussion, our legal and compliance groups have asked us to highlight disclosure information. Trust and investment management services are offered through Regions Wealth Management, which is a business group of Regions Bank. The opinions expressed in this roundtable discussion are those of the presenters and not necessarily of Regions Financial Corporation or any of its subsidiaries, and the opinions may change. Now to the heart of the discussion, we'll begin with Chris Scribner, Public Policy Manager of Government Affairs for Regions. Chris, every day there's something new in the political environment, new reports, new leaked sources and information. What are your expectations for passage of the Republican economic agenda, including tax reform, changes to health care, and the budget, given this political climate and backdrop that we have right now?
Well, certainly after the elections, there were big expectations that the Republicans in control of the House, the Senate, and the presidency would be able to move quickly on an agenda that had been laid out in general strokes in the campaign. And I think what people missed in that outcome was the fact that the Republican Party is not unified on core economic issues. And we saw that immediately in the House, the difficulty within the House of passing health care reform, eventually passing a bill that the Senate has said it's going to almost start over. So the delay on health care, the divisions within the Republican Party have slowed down the legislative process. That's also true on tax reform, where there is differences between the administration and House Republican leadership on the goals of tax reform, on the ways to achieve it, from deductions, from whether it should be deficit neutral or should be a tax cut, in a sense how it will be funded. So a lot more discussion on the particular policy aspects I think observers had thought had been sort of vetted during the campaign. As a result, it is looking unlikely that there will be significant reforms to the tax code in 2017. It's unclear at this point whether or not there will be significant reform to health care, the ACA, as Affordable Care Act as well. Our expectation is there will be some form of corporate tax cut, relatively small at the end of the year if there is not a broad reform package. So there will be some minor change to corporate tax rates, but not a significant reform of the tax code.
What about from a regulatory perspective? The administration has had an agenda to roll back regulations, to free companies from excess regulations, as the administration has said. How successful do you believe the White House can be in achieving that goal?
I think the effort to roll back regulations is really industry by industry. It depends on the ability of the president or the cabinet secretary to directly either stop regulation that was about to go into effect, which, while not rolling back a regulation, would stop an expected change, or to change the direction of policy by the act of the agency itself. In some industries, energy is a good example. There were several regulations that were poised to go into effect that have effectively been stopped, or that were passed late in the Obama administration, where Congress was able to use the Congressional Review Act to reverse that rule. And then there are other industries, financial services as an example, where many of the agencies are independent. Therefore, there's not a new agency head at the time of the election. The heads of those agencies do not serve concurrently with the president. So the change in policy will take longer to go into effect, and in many cases need Congress to act to pass laws to direct the agency to change the regulations.
Let's bring in Richard Moody, Regions Chief Economist. Richard, in the wake of last November's elections, there was a burst of optimism over the prospects for meaningful policy changes that would lead to faster economic growth as well. Yet while measures of business and consumer sentiment, or the so-called soft data, remain elevated, the hard data that measure actual economic activity have been pretty lackluster so far this year. How do you reconcile the two?
Well, the first thing I would say is that there have been a lot of measurement issues that have plagued the economic data so far this year for a lot of reasons, including what was an atypically mild winter. But even beyond that, your point remains the same. We're still operating at kind of the same 2% trend rate of growth we've seen for almost the last 8 years now. But nonetheless, consumer confidence, business sentiment still remain very high. And I think it's important to distinguish between what's driving consumer confidence and what's driving business confidence. So as you mentioned, in the wake of the election, business confidence really took off, hit multi-year highs. Prospects of meaningful tax reform, regulatory reform, had corporations feeling much more optimistic for their prospects this year. So far, none of those things have really played out. And so therefore, we've seen a little bit of growth in business investment, but corporations are still very restrained. In fact, I hear this a lot when I speak to some of our commercial clients, that they're basically in a holding pattern right now. They have plans in place, they know what they want to do, but they need to know the environment in which they're going to be making these changes. So as one of them put it to me, we don't want to do something today that 2 months from now we will wish we had done differently once we see how the policy changes play out. So we're really seeing that the corporate sector in more or less of a holding pattern, waiting for some clarity on the policy front. Increasing consumer confidence has been driven by much more tangible factors. So if you think about, we have record high household net worth. We've seen ongoing improvement in the labor market. It's fueling solid growth in personal income. Interest rates still remain favorable. So consumers are really feeling much better about their own condition. So the rise in consumer confidence wasn't so much predicated on hopes for policy changes as it was tangible improvement in household financial conditions. And if you look at what's driving the economy, it's still more or less the consumer sector. So again, the data have been uneven from month to month, but if you just look at the underlying trends, the consumer is still the main driver of the economy, and yet the business sector is still in a holding pattern. And so the net result is a continuation of the same 2% growth we've seen for the last several years now.
Let's bring in Alan McKnight, Chief Investment Officer for Regions Asset Management. Alan, given this recent spate of volatility or uncertainty, how is the stock market thinking about or reacting to the turmoil in Washington, and how do Washington's decisions impact positioning and your views going forward?
Jeremy, as we look back over history and we want to give a historical context for this, we think about a speech that Winston Churchill made back in November of 1942. And in it he said, after a recent battle win at El Alamein, that now is not the end, it is not the beginning of the end, but perhaps it is the end of the beginning. And to Richard's comments and to Chris's comments, we think that what's going on from a political perspective and economic perspective is really just the opening salvo. And the markets since November 8th have been reacting to the possibility that it is in fact the end or the beginning of the end as it relates to regulation, taxes, and the healthcare infrastructure to date. So as we think about how the market's going to continue to react going forward, what we look to is getting implementable ideas, executable thoughts, and actual bills passed, and that hasn't occurred. So until that does occur, we think the market's going to be more volatile and be in a bit of a holding pattern through the summer months. And if we don't see something that actually comes to fruition as it relates to the tax piece or on the regulatory front, healthcare, or even infrastructure spending, we think it's going to be difficult for the market to continue to push higher over the next 6 to 8 months. Now, if we start to see something that's at least agreed upon, to Chris's comments earlier, where we actually see at least one side of the aisle behind one of the bills, and we start to actually see something that could move to passage by end of the year, then there's an opportunity for the market to push higher. And what we would showcase is the stark contrast of where we are right now versus, say, the benefit that international markets have received. And international markets have improved over the last few months in light of what's been going on in the Eurozone with better than expected elections, with the discussion at the ECB level in terms of shifting down the balance sheet. So those markets have rallied while our markets have stayed relatively stagnant. So we see in the coming months a bit of stagnation and volatility until we get more clarity on the policy front.
And speaking of the Eurozone and looking ahead there, specifically to overseas markets, have your views changed on that region moving forward long term, or do you see that continued growth or progress continuing?
We've actually become more constructive on Europe, and we've been that way for the past year as things have started to improve. And we think we're now actually seeing the policy behind that as it relates to the European Central Bank, as well as on a country-by-country basis. And when you look at what's going on from an inflationary perspective, from a GDP growth perspective, things are improving. Now, it's taken a long time for that improvement. When you think back to March of 2009 globally and what was going on, and from an economic perspective in 2009 and 10, it's taken some time, but we're finally starting to see those green shoots in Europe, and we think that will actually continue in the next year or two. And with valuations where they are, it makes it much more intriguing to us to start allocating capital to Europe and more broadly internationally.
And how about back to the U.S., the bond market here? How has it been reacting to both the turmoil in Washington as well as the indications of the Federal Reserve for continued rate hikes as well?
Well, as we've talked about last year, if you look at point to point over the course of 2016, almost nothing happened in the bond market. But if you look at it during the year and you see that the 10-year bond dropped to 1.36, finished the year at approximately 2.4%, we had a lot of volatility. The market right now, as it relates to the bond market, is telling us that they don't necessarily believe that things are improving at the rate that maybe the equity markets do. And we've always thought that the bond market is as smart a market as you will find globally in terms of real adjustment to current economic indicators as well as growth objectives. And to date, being down almost 20 basis points on the 10-year bond, we would say that people are still in wait-and-see mode. And until such time that we do get more policy clarity and we start to see a continued rate hike from the Fed, we don't anticipate a dramatic shift up in the curve and in rates over the coming 18 to 24 months. We think it's going to be a gradual uptick, and because companies are in as good a position as they've been in decades as it relates to cash on the balance sheet, the low cost of capital, they're very well positioned as well. So things like investment grade corporate bonds, high yield bonds are actually well positioned right now.
And let's turn to Richard Moody, Regions Chief Economist, on that point. Richard, the Federal Open Market Committee has seemed poised to raise the federal funds rate by 25 basis points at its June meeting, which would be the second such hike this year. This comes after a total of 2 rate hikes in 2015 and 2016 combined. So what's gotten into the FOMC this year, and what is your outlook for additional rate hikes over the remainder of 2017 as well?
Well, what's gotten into the FOMC this year is they're looking at the state of the economy and judging that even in a world of 2% growth, we've made sufficient progress in the labor market with an unemployment rate of 4.4%. And up until recently anyway, they were comfortable on the inflation front. That inflation was moving towards their 2% target. And as they assessed conditions in the broader economy, they simply decided monetary policy was too accommodative. Again, even in a world of 2% growth. So they have been messaging to the markets that they expect to raise the funds rate a total of 3 times this year. As you mentioned, we got one of those in March. We fully expect we'll get another one in June at the June FOMC meeting. And the way the Fed thinks about it simply is that if you look at the inflation-adjusted federal funds rate, it's still about negative 75 basis points, which again, even in a world of 2% growth, is simply too low. So what the Fed is worried about is the fact that we're almost at full employment if we're not already there. They're worried about a burst of inflation, which again looks less and less likely, but nonetheless, while we think and the financial markets have almost fully priced in a rate hike in June, what's become more uncertain over the last couple of weeks is whether we'll get subsequent rate hikes later in the year. So what's become less certain is to what extent we'll get further rate hikes later in the year. We have seen inflation decelerate. So instead of moving towards the Fed's 2.0% target, it's actually started to move away from that target the last few months. And to Alan's point, the bond markets have reacted to that. We've seen long-term rates come down some. We've seen short rates back off. Short rates are more sensitive to perceived changes in the Fed funds rate. So the markets are questioning whether or not we're going to get that third rate hike this year. And another factor that I think is becoming more of a concern is the political outlook, just in the sense that come August, September, we'll have to start addressing the debt ceiling. And there's potential for disruption in the markets depending on how that resolves itself. And the Fed would probably not be willing to hike in an atmosphere of heightened uncertainty over the political outcome. So the bottom line is that even in the 2% growth world we're seeing, the Fed feels the need to act with a little bit more urgency than they have in the past few years.
And Richard, there's been considerable discussion of how and when the FOMC will begin to unwind the Fed's $4.5 trillion balance sheet. Can you discuss the significance of this, specifically what impact it might have on interest rates, and how do you see the FOMC proceeding in the process of unwinding the Fed's balance sheet?
As you mentioned, the Federal Reserve's balance sheet is now $4.5 trillion. And to put that in perspective, prior to the crisis, it was around $800 billion. So over the last several years, they were actively buying government debt, mortgage-backed securities, mostly longer term, attempting to hold down long-term interest rates to try and stimulate economic activity. Now, they stopped actively buying assets a couple of years ago, but ever since they've been reinvesting the proceeds of maturing assets. So they're still active in the markets reinvesting these proceeds, so they're still getting some impact on long-term interest rates. And again, as the FOMC sees the economy now, they feel it's time to start weaning the markets off of these artificially low longer-term interest rates. Having said that, what they want to avoid is a disruptive increase in longer-term interest rates. So they're looking for a way that they can basically start to walk away from these reinvestments. And to use the term that one of the FOMC members used last week, we want this to be the policy equivalent of watching paint dry. So in other words, they want to avoid disruptions in the market. So what we think will happen is they will announce a plan under which they will stop reinvesting proceeds at a given rate. Very gradual, so again, to avoid disruptive increases in long-term interest rates. They'll kind of define this course, and unless something extraordinary happens, they'll stick to this course. So again, they would like it to be as much of a non-event as it can be, but what we don't know, because again, we're in uncharted waters here, is how are the markets going to react? And so that's why I think the Fed has devoted so much time discussing this publicly. They're spending a lot of time at the FOMC meetings, kind of refining the plans. And I'm not quite sure we'll get their plan in June, but by the end of the summer, we expect them to be communicating with the markets as to this is how we're going to proceed, this is the rate at which we're going to pull back the reinvestment, and that will probably begin either late this year or early 2018. So hopefully we'll avoid these disruptive increases in long-term interest rates, but again, given that this is something that has never been done before, we simply don't know how it's going to play out.
Along the theme of looking ahead toward 2018, Chris Scribner will bring you back into the discussion here. We've talked about the political climate, the current climate. We've talked about what's happened since the election. Looking forward now, what are the political issues that you believe might change the odds for enacting the current policy agenda? And are there other issues on your radar that need to be considered for the rest of this year?
I think the critical aspect of answering that question is whether or not the Trump administration takes control of the policy debate on healthcare reform, on tax reform, to a lesser extent on the budget, which is more difficult to move. And our perspective is often so short-term. We think, what has the administration done in its first 100 days? And we should look out a little longer and give the administration more time, because it is very difficult to change policy with the way our government's structured. That said, as one example, during the healthcare debate, one member of Congress said calls into his office were 4-1 against Ryan care and 4-1 for Trump care. and it was the same policy. The point is that if the president puts his prestige, the prestige of the office, has a clear set of policy goals and can push the Republicans to force the Republicans to follow him, there is a much greater chance of enacting policy change. Richard raised a good example that will be an indicator of whether or not that happens. Secretary of Treasury Mnuchin came out strongly last week for a clean raising of the debt ceiling and wanting to do that in July before the August recess ahead of the deadline in the fall to do that. If there is a clean raise where Republicans can rally around a simple policy, we'll see proof that the president has led on an economic issue that may lead to more unity on other issues, tax reform, potentially health care reform as well in the fall. So that will be a clear indication of what we might expect later in the year.
And Richard, to some degree, I'll ask you the Economist's version of the same question. What are your expectations for changes to regulatory, fiscal, and trade policy? And how do those expectations alter your view of the economic outlook looking forward?
I'll start by saying that since the day after the election, we've been trying to walk back some of the expectations around what we're going to see. Our point is that the policy changes we were most likely to get would be less sweeping than people had been hoping for, and that they would take longer to get than people had been hoping for. So we saw it at best as policy changes might affect the economy in the fourth quarter of this year. Now we're already in June effectively, and basically every day that goes by, it just lowers our expectations a little bit more because 2018 is a congressional election year. So the odds of any sweeping changes next year are probably slim. So Chris mentioned earlier, what we'll probably end up with are just more moderate changes than people have been expecting. And our baseline forecast called for real GDP growth of a little bit over 2% again this year, no surprise. We have not incorporated any policy changes into our baseline outlook just because we don't have any meaningful proposals at this point to evaluate. And to the extent we get short-term changes in tax rates that don't really alter the underlying drivers of economic growth, specifically business investment and labor force participation, then it diminishes the chances that policy is really going to move the needle on economic growth. So our expectations all along have been tempered, but I think the longer we go on in this environment of just political paralysis, then even our tempered expectations get diminished further and further.
Alan, from your perspective, any long-term investment trends or themes that we need to watch going forward?
Certainly a few. One, as Richard noted, if we aren't able to escape this terminal velocity, if you will, around the economy, if we can't start to see a pickup in GDP growth that the market is expecting, we certainly see that as a challenge and a long-term challenge within the United States. But when you think more thematically, one idea that we've had and thought is around the silvering of the globe. And when you look at the demographics of the global economy and you realize that in 2025, more folks will be over the age of 65 than under the age of 20 for the first time in the world's history. And by 2050, in the entire world, there will be more folks over the age of 65 than under the age of 20. It really changes the dynamic as it relates to markets and how income and spending will be involved in that, which shifts to our next theme, which is how do you generate income in that type of world? When there are more investors who are looking for sources of income, for opportunities, what does that mean for asset prices? And more importantly, what does it mean for global markets in terms of the functioning of those markets and the opportunity set for investors? And then finally, on the global front is one that I had noted earlier around the developed world improving. The U.S. has been the best house in a bad neighborhood. We're starting to see some improvement, some Home Depot work around the other houses. And that's certainly a positive for us as we've started to allocate more money over to the international asset classes. We're intrigued by what's going on in the emerging markets and the improvement there, as well as what's going on in Europe. Japan still hasn't picked up the pace, if you will, and they have some demographic challenges, to my first point, that they really have been unable to escape. And if you look at what the Bank of Japan has done, they still don't have a real plan, and they've been fighting this for the better part of 26 years as it relates to those challenges. So we're intrigued by the international side, but it's very specific in terms of region, not on a whole globe basis.
Alan McKnight, thank you so much. And thank you, Richard Moody and Chris Scribner as well, for joining us today. And we'd like to thank everyone for taking the time to listen to this edition of the Economic and Market Roundtable. If you would like to discuss your own investments and positioning for the future, you can call 1-800-REGIONS and a Regions Wealth Advisor will return your call, or visit regions.com and check the wealth management section. There's a contact form there that you can fill out and someone will be in touch. I'm Jeremy King. Thank you for listening. We'll see you next time.